Hello, and thank you for joining us for Kaya Seattle's webinar on Opportunity Zone Fund Investing. This event is being recorded and will be distributed to registrants following the webinar. We encourage audience participation, so please use the Q&A or chat features to ask questions to our speakers. Here to open our event is the Kaya Seattle chapter head, Chris Carsley.
Hi, everyone. Hey, thanks for joining us this evening to talk about what is definitely a timely subject. So I'm looking forward to getting the updates. For people who are not familiar with what the CAI is, or Kaya as some people call it, it's a nonprofit organization with over 30 global chapters and literally tens of thousands of specialists in alternative investments, performing research and providing network for people who want to come in and educate themselves and be part of that network in alternative investments. So if you want further information about that, you can reach out directly to chapters@cai.org, or if you know someone within a chapter within your geography, please reach out directly to that chapter head or board. And, we're more than willing to talk to people. We love new members. I know here in Seattle in the Pacific Northwest, the meetings are free. Whenever we get back to in-person meetings, we love to, invite new people into our region, that regardless of whether you're in venture, whether you're a hedge fund, whether you're in real estate, we cover a little bit of everything in alternative investments, as you'll see in this conversation here. So with that, please reach out if you're looking to do due diligence. As everyone's starting to look in alternatives, I hope everyone's not too hurt in their portfolio from our January performance in the stock market. But with that, I'm going to hand it off to Nick Rosenthal from Griffin, and he will do some introductions and then guide us through our presentation today.
Great, thanks, Chris. I want to take a moment and express my gratitude to you and the folks at the Kaya Seattle chapter for sponsoring this event. I know it takes a lot of work to put a forum like this together, and anytime we have an opportunity to provide some education around opportunities on fund investing, certainly something that we find worthwhile. As Chris said, my name is Nick Rosenthal. I'm the Managing Director of Advisor Solutions here at Griffin Capital Company. I'm joined by Kevin Shields. Kevin is the founder, chairman, and CEO of the firm, as well as by Eric Kaplan. Eric runs Griffin Capital Company's private equity division, and that is the division here at Griffin under which our opportunity fund investing platform sits. So today what we'd like to do is really provide some education around what's going on in the opportunities on fund space, really changes from 2022 versus 2021 as investors looking to allocate to the space, as well as really address questions around the investment merits surrounding the underlying investments. Obviously, it's our fundamental belief that the tax benefits are transformative, but in the absence of a good underlying investment, attractive tax benefits won't make a bad investment a good one. So it really first starts and ends with the investment, and then the tax planning characteristics that opportunities on fund legislation allows for creates some really unique and interesting planning strategies, as well as helps to augment the after-tax investment returns. But it really should be about what does the underlying investment look like. So we'll talk about that entry point as well. Before we get started, I just want to provide a little bit of an overview on Griffin Capital Company. We were founded in 1995 by Kevin. Since that time, we've owned, managed, sponsored, or co-sponsored approximately $21 billion in investment offerings. Our senior management team has on average 25 years of experience across the platform, so certainly cycle tested. We have been involved really in a myriad of investment strategies and structures, all really surrounding the real estate investment space. Our 40 Act interval fund business, which is a combination of both real estate and credit, is being sold to Apollo in a transaction that was announced in December. Our public REIT strategies, which were publicly registered non-traded REITs, are now all internally managed by the various and sundry management teams. So our focus at the firm today is really our direct real estate platform, which is predominantly focused right now on multifamily development, and that is both in a non-taxable format, which is the Opportunity Zone Fund platform, and more of a build, stabilize, sell strategy, and a merchant build investment development strategy, also focused on multifamily. Since in the inception of the firm, we've completed over 650 real estate transactions, totaling $25 billion in transaction volume. But what I will tell you, really sets us apart is our alignment of interest with our investors. We are investors first and foremost, and that shows up in our co-investment across our platform. Griffin Capital, along with executives and employees, have invested in excess of $300 million of capital into our offerings. And that's really how we became interested in the Opportunity Zone Fund space. So as we were looking at the draft legislation in 2017 that ended up in the Tax Cuts and Jobs Act at the end of 2017, we were really taken by the unique tax benefit characteristics that we saw. We didn't feel comfortable building strategy around that until 2019 as the Treasury came out with clarifying regs. But we have been very active investors in the space and observers in the space since 2017, really formulating our first fund in 2019. Since that time, we've raised two funds, all focused on ground-up multifamily development. Those offerings are closed. We are building $2.2 billion in total project costs of 21 multifamily communities totaling 7,300 units and 20 distinct qualified opportunity zone census tracts. So we have been very active as investors in this space, and our strategy has been exclusively focused on multifamily. We launched our Fund 3 really in November, started taking in capital middle of December, and we've raised approximately $70 million in investor capital over the last 7 weeks in Opportunity Zone Fund 3, which is our current strategy. All of that capital at Griffin comes through financial intermediaries. We do not take direct investors. So we work with family office, multifamily office, registered investment advisors, wirehouses, and broker-dealers. And those are the relationships that we support at the firm, and their clients are our investors. As we begin to start this conversation, I want to bring in Kevin. Kevin, as I mentioned, is the founder and CEO of the firm. And I'd like Kevin to spend a little bit of time level setting on the Investing in Opportunity Act, in which Subchapter Z was created from, which governs opportunities on fund investing, just to give everybody an idea of what the associated tax benefits are for opportunities on fund investors. So I'll kick it over to you, Kevin, and let you share a little bit about the tax benefits. Thank you.
All right, great, Nick. Thank you for that introduction, and I echo your sentiments. It's a pleasure to take part in the Kaya event, and we started before we went online here. Chris had indicated that he gets calls from people asking whether or not the qualified opportunity zone opportunities still exist, and we're here to certainly reinforce the fact that they still exist, and there's still phenomenal opportunities associated with, for us, development opportunities in multifamily. As Nick indicated, the Investing in Opportunity Act was a small bill that got subsumed into the Tax Cut and Jobs Act in December of 2017. We started taking a pretty close look at this legislation really early in the first quarter of 2018 to try and figure out what strategy we wanted to bring to market and with whom we wanted to partner from a joint venture development perspective. And we have kind of assembled a kind of a who's who of national multifamily developers as our strategic partners. But as we sit here today, and to answer the question about whether or not it's still viable to invest in a qualified opportunity zone fund, ultimately, to the extent that you invest in the fund today, you realize the capital gains event, invest in the fund today, you don't pay your capital gains tax until your first tax installment in January or in 2027. So the actual capital gains tax defer through the end of 2026, which is a nice benefit to have that present value effect of the deferral. But really, the economic driver behind the legislation and the significant component of the tax benefits associated therewith is, to the extent you stay invested in a qualified opportunity zone fund for a period of 10 years or more, then you will receive at the end of that 10-year period 100% fair market value basis step up in whatever the fund invests in, or in our case, develops. 100% fair market value basis step up. So that means that when you sell one or more of the assets in the fund, or they sell the entirety of the fund in one fell swoop, any capital gain that was realized is associated with that development activity and the growth of those assets is returned to the investor tax-free. And that's a pretty phenomenal benefit at the end of the day. And that's the benefit that continues to exist even today. So here's really more of a graphical depiction of that timeline. So the Investing in Opportunity Act was really intended to stimulate and motivate Americans who have got embedded capital gains on their balance sheet to liquidate those capital gains, generate a capital gain event, and redeploy those capital gains into qualified opportunity zones. And there are 67 some odd zones targeted that were addressed and identified in the middle of 2018. And to be a qualified opportunity zone, you really have to manifest one of two characteristics. You have to have a poverty rate of greater than 20%, or prevailing median family income at or less than 80% of the metropolitan median family income. So it's really intended to redirect capital gains into communities that need the development activity or need the investment activity. So you sell whatever asset, and it could be any capital gain, unlike a 1031 exchange, which is all targeted specifically to real estate. It could be any capital gain. It could be long-term capital gain. It could be short-term capital gain. It could come from the sale of an operating business. It could come from the sale of collectibles, a stamp collection, a coin collection. It could be low basis, highly appreciated stock. Anything that triggers a capital gain is eligible to be invested in the Qualified Opportunity Zone Fund. And the real tax benefits attach themselves to the capital gain. So once you exercise a transaction or consummate a transaction and generate a capital gain, you've got 180 days in which to redeploy those capital gains into a Qualified Opportunity Zone Fund and get the tax benefits associated therewith. So 180 days to invest in the fund. Again, you don't have to pay the capital gains tax on a realized capital gain until 2027. So you get deferral through the end of 2026. And then you stay invested for the 10-year period. You get 100% fair market value basis step up. A couple nuances to that rule. So pretty straightforward. If you're selling low basis, highly appreciated stock, the day in which you transact on that stock sale starts that 180-day period clicking. If you, however, were an investor in a pass-through vehicle, a partnership, if you were a limited partner in a partnership or a member of a limited liability company, any pass-through vehicle, if the pass-through vehicle itself, the partnership of the LLC, sells an asset, triggers a capital gain, and distributes those gains, as a taxpayer, you have three different options with which to commence the tolling of the 180-day period. You can either pick the date at which the pass-through vehicle actually sold the asset, much like if you had sold stock individually. The day that they sold the asset gave rise to the capital gain, you got 180 days. But you got a little bit more flexibility. You could also pick the last day of the pass-through vehicle's taxable year, which generally tends to be the end of a calendar year, so 12/31. So that would push your capital gains investment period out through close to the end of June. Or you also have the choice to pick the date of the pass-through vehicle's tax return without extensions, which is generally March 15th for a pass-through vehicle. So if you pick the latter date, you really have until September 11th, 2022 to redeploy those capital gains. So as an advisor, one of the things that you want to be contemplative of and consultative of with respect to your clients is there's still opportunities to engage in creative tax planning for gains that were realized and passed through a pass-through vehicle in 2021. So a capital gain recognized by a pass-through vehicle that ultimately was distributed to those investors at any point in 2021 theoretically could be redeployed into a Qualified Opportunity Zone Fund all the way through up to and including September 11th of 2022. So still opportunities to engage in tax planning for gains realized in 2021. So one of the things that this slide tries to articulate is really what are the benefits on a side-by-side basis of investing in an asset that isn't a Qualified Opportunity Zone Fund versus virtually the exact same asset across the street in a non-qualified opportunity zone. So as the basic assumption here is you invest $1 million. You invest $1 million. The investment generates a 9% cumulative internal rate of return over a 10-year period. What does that look like on an apples-to-apples basis? So if you just look to the bottom right-hand corner, net of tax, you're going to generate $1,685,000 worth of net after-tax proceeds, inclusive of your initial invested gain, by investing in an asset that is not located in a qualified opportunity zone. Conversely, the right part of this chart is what the return characteristics look like if the asset is in a qualified opportunity zone. Same economic characteristics, assumes a 20%, a capital gains tax rate, the 3.8% ACA, and we just picked kind of a middle of the road conforming state that has a 5% state income tax. And in this instance, the Qualified Opportunity Zone Fund investment throws up just shy of $2.1 million in net after-tax proceeds. So an additional $394,000 of additional proceeds for having invested in an asset in a Qualified Opportunity Zone fund, in a Qualified Opportunity Zone versus one that is not. So a 23% lift in that after-tax proceeds. I appreciate the comment that Nick made, and I'm going to reiterate it, and it's something that we kind of return to thematically time and time again, which is as you can see from this chart, the tax benefits are significant on a relative basis, but the tax benefits themselves do not make a poor deal a good deal. They do make a good deal an exceptional deal, given the additional 260, 270 basis points of internal rate of return that the QOZ investment is going to drive over that 10-year period. But fundamentally, it all begins and ends with your analysis of the sponsor, their investment thesis, the asset class in which they intend to invest, how they're going to deliver that asset, how they mitigate risk, because a lot of this is really geared towards development or substantial renovation. On the real estate side, there's a whole nother world of investing in qualified opportunity zones, the businesses that are located in qualified opportunity zones, which is kind of separate from the world in which we populate, which is the real estate world. But again, I'm going to continue to emphasize it begins and ends with the real estate asset. So you've got to have a very acute focus from an underwriting perspective on the sponsor, their thesis, the asset class, and ultimately the asset in which they intend to invest.
Kevin, as you mentioned real estate, one of the things that might be helpful is to talk about how real estate income is treated from a tax perspective in this structure. And then I want to ask you a question about this slide that just came through.
Yeah, so the short answer is it's a development transaction. So in our case, with respect to the funds, our first fund, we raised $460 million to develop 9 communities. The second fund, we raised $585 million of equity to develop 12 communities, totaling 21 and 2.3 billion of development in the forward pipeline. And ultimately, you can kind of anticipate, as we do on a pro forma basis, when you're going to start to make cash flow distributions. And I'm going to return to our ability to create liquidity during the life of the fund toward the end of the presentation. But ultimately, as we build an asset and deliver the asset and stabilize it, we'll recapitalize the asset with permanent debt, start to make tax-free distributions. When you're making a debt finance distribution, if you recapitalize a real estate asset and pass through to limited partners or members of an LLC distributions in an other than QOZ environment, in a subchapter Z environment, generally the distribution is tax deferred. So you don't pay any tax on the distribution from debt finance proceeds up front. However, it does reduce your basis in your partnership interest or your membership interest in the LLC, which catches up to you at the back end when you sell the asset, because you're paying capital gains tax on the difference between the net sales price and your adjusted basis. But here, by virtue of the step up in basis accorded us by subchapter Z of the code, that the interim distributions that you're making from debt finance transactions are really tax free. And then on a cash flow perspective, as we deliver those assets, stabilize them, which means we're leasing them up to high 80s, low 90s occupancy, the point at which we would recapitalize the asset with permanent debt and retire the construction loan, we'll start to push through to the fund investors, of which we are one. We've invested capital in each of our 3 funds. We'll start to making cash flow distributions on a monthly or a quarterly basis. And so if you look at the portfolio, you start with 0 current cash flow. You're getting some tax benefits in the interim, passive loss pass-throughs because you're depreciating the asset. Then you'll start to ramp up your cash flow. You'll ramp up the recapitalization distributions, but the cash flow distributions themselves are highly tax advantaged as well, because you're in a pass-through vehicle and we're generating depreciation deductions, which is sheltering the current cash flow distributions. And again, because there's no concept of recapture in QOZ world, it all is returned to you effectively on largely a tax-free basis.
Thanks, Kevin. So these become very tax-efficient income vehicles down the road after the assets are stabilized.
Correct.
So one of the questions that came through was for individual gains, when you're looking at your 180 days, that 180 days has the ability to span calendar years, correct? So if I harvested gains in October of November of 2021, I'm doing tax planning here in January or February, those gains are still eligible for opportunity zone fund investment as long as I make that investment within 180 days, correct?
That's correct.
Okay, thank you. So a lot has been made as we saw flows into opportunity zone funds accelerate at the end of 2021 about a specific benefit sunsetting for opportunity zone fund investors. And the question that a lot of fund investors have for 2022 is, did I miss out? So I think it would be helpful if you could articulate the difference in entry point for a 2022 investor relative to 2021 investor, relative to that tax benefit and what it might mean.
Yeah, it's, as I said earlier, the substantial component of the tax benefits associated with Subchapter Z of the code and making an investment into a qualified opportunity zone fund is that 100% fair market value basis step up that you get at the end of the 10-year period. The deferral is a nice benefit. If you go back in time to the point in which this legislation was first adopted, the way it was drafted is, to the extent that you had an investment in a fund for a period of 7 years or more, you would have received a 15% basis step up in your zero basis capital gains. So generally speaking, your capital gains have zero basis. If you invested $1 million at the end of 2019, you're really only paying capital gains tax on $850,000. You get a 15% basis step up. If you had held your investment in a fund for 5 years or longer, you'd get a 10% basis step up. 5 years or longer prior to the end of 2027. So that trigger point was really 12/31 of 21. So if you had invested in a qualified opportunity zone fund prior to December 31st, 2021, you would have still benefited from a 10% basis step up in your zero basis capital gains. So again, if you invested $1 million, you're only paying the capital gains tax on $900,000. You're getting that 10% basis step up. It's almost comical to me how much that drives people's decisions to try and get in before the end of these sunset periods. I mean, we raised a tremendous amount of our equity in the first fund in December of 2019. We raised a significant amount of equity in both the closeout of our Fund 2 and the launch of our Fund 3 in December of 2021, because the investors were trying to capture that last 10% basis step up. And the reason I find that comical is people got really panicky about making sure that they get in before 12/31. And our mantra really has always been, look, don't rush into an investment decision for the sake of garnering that additional 10%. Take a step back, take a deep breath, recognizing the fact that that 10% basis step up is not really going to significantly tilt the windmill. You want to make sure that you're making the right investment first, returning to that theme that it's about the real estate first and foremost, and the tax benefits are secondary. And by the way, if we just run through a very simple analysis to quantify over a 10-year period what that 10% basis step up means in terms of internal rate of return, you can see right here in the middle of this this chart that the after-tax internal rate of return for an investment made in 2021 would drive about a 7.3% internal rate of return, as opposed to a 7.11 or a 7.11% return to the extent the investment was made in January. So it's really only 19 basis points in total return. And if you're talking about a underwritten total internal rate of return of before the tax benefits of, call it between 8 and 10%, and then you add the 225 basis points on top of that, which is the tax benefits, you can see the 19 basis points are really not material. So it's kind of funny. It gets back to the question that Chris was asking just before we got online here, which is there still qualified opportunities on fund investments available? Is it still a product? It's very much a product. It's very much still a product that can generate significant tax benefits as a result of that 10-year holding period. And the fact that you've missed out, quote unquote, missed out on the 5 or 10% basis step up really is not material in the grand scheme of things from an overall return perspective.
Thanks, Kevin. So assuming that 20 basis points or 19 basis points doesn't shy you away from the space, I guess the question becomes, is the entry point attractive from an investment perspective? And so I want to bring in Eric Kaplan, who I mentioned is the president of Griffin Capital Private Equity, who runs our opportunity zone fund business and oversees now over $2.2 billion of multifamily developments in the space. To give us a sense of sort of how the market is shifting, obviously we saw record real estate transaction volume last year, over $600 billion of real estate transacted in the U.S. Yields have been low. Institutional investors have been increasing their allocations to real assets. Eric, from your perspective, we have focused at Griffin on multifamily. What is your perspective of why that continues to make sense? All right, you'd have to be unmuted, Eric, for to get your perspective. Liz could unmute you. That would be great.
Eric, go in the upper right-hand box of your picture.
Okay.
There you go.
Here we go. Okay, good. Sorry, I was trying.
Thanks, Liz. No problem.
Great. Thanks, Nick. So, as you alluded to, why did we choose multifamily? And as a firm, we've invested in multiple property types and really have expertise across the full spectrum. And at a macro level, when you're thinking about a long duration capital investment, like a QOZ investment, you want return characteristics that are stable and predictable. And as you can see from the slide, when you compare the performance over 1 to 10 year rolling holding periods for multifamily versus industrial, retail, office, and hospitality on a risk-adjusted basis, which is the Sharpe ratio, which is commonly used, you can see that multifamily has continually outperformed those other asset classes. So great historical performance, but then when you want to look forward, there are a number of long-term secular trends that are providing tailwinds to the multifamily space. Number one is there's a well-documented housing shortage. The government's just not doing enough to provide housing. In addition, as you can see from this slide, home prices are increasing more rapidly than income, making home buying out of reach for a number of folks, which allows landlords to raise rent. So, for example, home prices were up 16% in 2021 nationwide, and rent growth on the apartment side was about 13%. So this increase in home prices is a great boon to landlords' abilities to raise rent. And then if you look, Nick, if you'll go to, there you go. If you look at this slide, there's good demand coming from both ends of the age spectrum. So on the Gen Z and millennial side, folks are tending to get married later. They're delaying their household formation. Again, homes are not affordable for them. They've got student debt. So homes are just out of reach to many of them. So they're continuing to rent longer. On the other side of the age spectrum are the baby boomers. And a lot of folks like myself, we don't need a 4 or 5 bedroom house. So we're continuing to downsize. And some of us are entering the renter market, and others will just buy a new home. So empirically, the multifamily sector's held up really well over long holding periods. And then the next question is, how has COVID, changed the industry and changed the strategy that we're employing? And we really think about it in two ways. How resilient was multifamily during COVID, and what changed, and how do we adjust our strategy? And the reality is multifamily was incredibly resilient. In fact, as you can see from this slide, rent collections never were below 92%. We had terrific rent growth. As I mentioned earlier, rent growth was 13% last year and is expected to be above historical averages going forward. But what we did see was an accelerated movement of population to the Southeast and Southwest markets. So, better weather, high quality of life, lower cost of living. So markets like Tampa, Phoenix, Nashville, all saw increasing population, and the pandemic just continued to accelerate this. And in our strategy, as Kevin mentioned, is very targeted. It's strictly ground up multifamily development, and we only invest in markets that exhibit this long-term job and population growth, where the gap between renting and owning is growing. So again, if you look at our 21 assets, Phoenix, Austin, Nashville, Denver, Tampa are key markets that we're investing in.
So, Eric, we've seen a lot of people retire. We've seen a lot of them move into these kind of lower cost, better live, work, play environment states. Obviously, that's driven housing shortages and challenges with affordability. But we've also seen a tremendous amount of capital enter the multifamily space, targeting core assets. So when you are thinking about, does it make sense to be a developer or does it make sense just to buy core assets? What is the dynamic right now between valuations in the core market versus sort of the spreads that you can achieve as a developer?
Yeah, that's a great question, Nick, and that really goes back to the earlier question: is the entry point still compelling for ground up multifamily development? And there are really three reasons that we're very bullish. The first is supply. We spoke earlier that most of these major Southeast and Southwest markets are undersupplied from a housing perspective. We don't expect that trend to change anytime soon and is likely to be enduring. And then secondly, on the demand side, investor demand for stabilized multifamily properties continues to increase, and that's for a number of reasons. One is just the stability of cash flow from apartments, particularly when you compare it to an office building where if you lose a tenant, your cash flow will be significantly diminished, just by way of example. So you're seeing a lot of demand come into the multifamily space for these stabilized properties. The institutional investors have always been big investors in multifamily. The pandemic has exacerbated this. In fact, Blackstone's bought over $7 billion worth of apartments just in the past 2 months. So as a result of these supply and demand factors, the spread between the cost to build, which is what we're doing by partnering up with the developers that Kevin mentioned before, and the ability to provide the product to the folks who are seeking stabilized cash flow, who want to buy an apartment building that's been constructed and well leased up, it's allowing us as the supplier of apartments to get very attractive risk returns.
And so ultimately, you're building assets into this market where valuations are very strong. Kevin, can you talk a little bit about how within the Opportunity Zone fund structure that effectuates the opportunity to have some interim liquidity?
Yeah, I will, but I want to just piggyback off some of the stuff that Eric said that I think is important. One thing is, because a lot of the questions we get are, we've got three vintages of funds, right? We've got the 2019 vintage, the 2020 vintage, and the 2021, now 2022 vintage. And the question is, hey, how have those opportunities changed? And, was it a better opportunity in 19 and 20 as opposed to 21 and 22? And to Eric's point, it's amazing to me how stable the relationship has been between exit cap rates or stabilized cap rates or free and clear yields and the yield to cost. So if we're building to kind of 150 basis point to 200 basis point spread, that number really has not changed that much over the last few years. And as a result, the opportunity we still find very compelling just from a pure asset perspective. And it's really a combination of things. So you think about inflation, or you think about interest rate volatility, or ultimately increasing interest rates, that drives up the cost of construction. So your yield to cost is going to start to get compressed. But at the same time, the capital flows have been compressing cap rates, and that relationship has remained fairly stable. The other thing about multifamily is it's very responsive to changes in underlying inflation. As you can imagine, the lease life of a multifamily property is anywhere from month to month to annual. So we have the ability to reset rents on a fairly frequent basis. I mean, the most responsive asset class to inflation is hospitality, because they reset the rents every night. But we've got $5.8 billion of office and industrial in our portfolio. Those much longer duration leases are less responsive to changes in inflation. So you're kind of in the right asset class if you anticipate increases in inflation going forward. But what this chart is intended to demonstrate is how, and I alluded to this earlier, how we drive interim liquidity through the four corners of the fund. Because the individual investors are not required to pay the capital gains tax upon the sale of the asset, they get deferral through the end of 2026. The question that we were asking ourselves structurally when we were putting the fund together is, how can we create interim liquidity by the time 2027 rolls around, so the individual investors don't have to look elsewhere in their portfolios for liquidity to pay those what would otherwise be phantom income tax liability, capital gains tax liability in 2027. And this is really intended to address that. So the bar chart in the middle is kind of our straightforward development asset, $100 million property. So I would say on average, our assets are all around $100 million. So as we finance that in the front end, we pick up a 60% construction loan or $60 million and invest $40 million of equity or 40% of the total capitalization to get to $100 million development cost. To develop a 350 unit, $100 million property takes a couple of years to develop the last asset. The units get released in phases, so you've got a lease up that's going over time. And then it'll take maybe another 18 months or so to stabilize that asset and get it to the point where it's got sufficient occupancy, which in our mind is kind of low 90% occupied, where you would want to exercise yourself in terms of replacing your construction debt with permanent debt. So if we put 55 or 60% construction debt in place over that 3.5 year construction to stabilization period, if you're developing in this example to 150 basis points yield to cost, so if you look at the left, you'll say the yield to development cost is 6.5%. That's driving a stabilized market capitalization of free and clear yield of 5%. That's at 150 basis points spread in the yield to cost. If you factor that in over the 3.5 year stabilization period, the math just dictates that at stabilization, your $100 million property is then going to be worth $130 million. It's just math. At that point in time, now that you've stabilized it, it's multifamily, so we'd return to the permanent debt market, which is largely driven by the agencies, Fannie Mae and Freddie Mac, put on a conservatively leveraged 65% first mortgage loan, permanent loan, pay off the $60 million construction loan. The 65% permanent loan equates to about $84.5 million of permanent debt. Now we're left with $24.5 million of excess debt finance distributions we can use to buy our joint venture development partners out of their promoted interest to the extent that they want to be bought out, and ultimately make distributions to the limited partners, which, as I said earlier, normally that would reduce your base of the partnership unit. In this case, by virtue of the fact you've got that 100% fair market value based stuff up, we can make those debt finance distributions on a very tax efficient basis, which is tax free. Are you muted, Nick?
I can't hear you.
Yeah, my apologies. I said, well, that's certainly powerful because you've got that deferred gain liability that's coming due in 2027. So the opportunity for some pretty significant interim liquidity certainly helps deal with that from a planning perspective.
Yeah, and I tell you, it's selfish on our part too, because we've invested $11.5 million of our own capital gains in the three funds. So as we sit down and think about structure, it's really, how do we solve the problem for ourselves? How do we solve the problem for all of our investors? We stand shoulder to shoulder with our investors. And it's one thing that I feel is compelling is to invest in everything that we ultimately develop and or sell so that we maintain a keen alignment of interest. And this is just one example of the alignment of interest that we keep with our investors. And I'm going to make one other comment about our focus on multifamily. And frankly, if it wasn't multifamily, it would probably be industrial, which has also been a very hot real estate commodity through the course of the pandemic, just given the Amazon effect. The problem with industrial is they tend to be smaller assets from a dollar size perspective. So if you're trying to get a good diversified fund of a decent magnitude from an overall size perspective, the multifamily asset class is very scalable. As you can tell, we're building assets that are each about $100 million. And we're focused specifically on a single asset class. So this relates to our fund, but also anything else that you might be looking at or analyzing. And we focus on a single asset class because the time and experience has taught us that's really the only way that you can derive a portfolio premium when you go to liquidate. So as much as we spend a lot of time on the front end in structure and design and fund design, we spend equally as much time, if not more time, figuring out what the monetization event is going to look like. How do we drive a positive economic outcome to our investors by investing in this particular fund? If we get to the end and we've got 9 or 12 assets in each of the fund 1 and 2, and we're looking to monetize, we've got a couple other arrows in our quiver by focusing on a single asset class. We can either sell the assets one at a time and break up the portfolio, but we stand probably a much better chance of driving a portfolio premium by selling it all in one lump sum. So if you've got $1 billion transaction, frankly, if Blackstone hasn't bought the rest of the world by then, we're happy to sell them the last $3 billion. As opposed to if you mixed your asset classes, if we had mixed multifamily with retail or industrial or hospitality, really your exit strategy is only one arrow. There's only one arrow in that quiver, and that's to sell the assets individually back into the market, because it's very atypical that you'll find a buyer who wants to buy multiple asset classes in a single transaction. You generally get better pricing and more aggressive pricing by people that are asset class specific. So, one of our big partners in Fund One is Avalon Bay. Avalon Bay is one of the largest publicly traded multifamily real estate investment trusts in the country, $40 billion worth of assets. They would be a nice natural candidate to buy a portfolio of assets that are ultimately we're going to be, approximately 10 years old by the time we're ready to unwind the fund. So it's an important element to think through. And as you're again thinking through the structure, the investment thesis, it's equally as important to think through the very end of the life cycle of the fund and think about the strategies that are going to be employed to monetize those assets or monetize that fund and drive the best possible outcome for the investors, of which we are one.
So when it comes to thinking through, obviously, the process, as you put on your hat as someone on the research side of the business, what advice would you give somebody as they're evaluating opportunity zones? And I'll leave that both to Kevin and to you, Eric.
Well, go ahead, Kevin.
I'll take the first stab at it from a more macro perspective. So, as you think through from an underwriting perspective, it's not just a question of, hey, I'm going to underwrite this particular fund, or I'm going to underwrite this sponsor, or I'm going to underwrite the investment thesis. I've got to get familiarity with respect to who the development partners are, how do they mitigate risk. It's also on the other side, which is what kind of capital do you want to invest in that fund? What kind of dialogue does the financial advisor want to have, or the registered investment advisor want to have with his or her clients in terms of counseling them? So let's assume you've gotten through the underwriting and you pick 2 or 3 fund sponsors that you feel comfortable with. It really kind of becomes a question of where do you want to attach those capital gains? What kind of capital gains do you want to have a forward-looking conversation with your investors and get them to stimulate capital gains that would not otherwise have been realized? So, we see a lot of our investors that have sold operating businesses. That tends to be fairly episodic, and it's kind of happening. It's happening around us, if you will, where people have sold a business, they sold an operating business, but they've sold it for whatever particular reason they have in mind in terms of how and why they want to monetize the business. Now they've created a transactional event, they've created the capital gains, and now this is a discussion that the advisor is going to have with his or her client about where they could potentially deploy those gains in a tax efficient basis. So the business sale is a big source of investment dollars that comes into our fund, but that's reactive, right? That's a transaction that's already happened. There's also an ability to be much more proactive as a financial advisor, which is you've got visibility into your client's portfolio. You can identify where they've got highly concentrated stock positions. You have a view as to the stock positions that have a low basis that have been highly appreciated. In fact, one of the transactions that I engage in to generate capital gains is at the behest of my children. When they were 9 and 10, they encouraged me to load up on Apple stock because they had this cool thing called an iPod, and that was going to transform the music business. So I literally loaded up on Apple stock in 1998, and I was sitting, and I never traded it, and I was sitting on these huge gains. So I was looking at our qualified opportunity zone. I'm looking at the tax benefits. I've got a lot of visibility in terms of what it is we're trying to create, who it is we're partnering with, and what kind of outcome I think we can expect. What a great opportunity for me to take some of that Apple stock, remove some of the gains from the table and reinvest those gains in a qualified opportunity zone fund, which happened to be our own. So there's a really good opportunity as a financial advisor or research analyst to think through portfolio dynamics in your individual client and to figure out where you want to mine some of those capital gains specifically to invest in a vehicle like this. And then from a real estate perspective, the odds are most real estate investors who are serial 1031 exchange people are really focusing on the 1031 exchange as the option. But the QOZ, the Qualified Opportunity Zone Fund, is an equally strong option to invest capital gains that are harvested through the sale of real estate. And they can interact. In fact, we had a transaction that we closed. We sold an asset up in the Bay Area in San Francisco, generated a very substantial capital gain for our 20 investors that were in that transaction. And we had 2 of those investors that took a portion of their money, invested it, kept it with the qualified intermediary, and consummated a 1031 exchange. And they also chipped off a piece of that capital gains and invested in our Qualified Opportunity Zone Fund. So there's a lot of discussion that can be had between the advisor and their clients in terms of strategizing from a tax perspective and looking through their portfolio to figure out where there are gains that are embedded on their balance sheet that should be freed up and redeployed into something, into a vehicle like this. So that's really more of a macro discussion. I don't know if Eric, if you wanted to be a little bit more fund or property specific.
Sure. To be a little bit more granular, as both Kevin and Nick said, first and foremost, this is a real estate investment. So you want to make sure you have the right sponsor, they have the right team to execute, they've got a track record of success. Who are you doing business with and how they fared over the years? Obviously, that's number one. And then are they investing in the right asset class, which can withstand economic cycles? As you know, we've told you, we're very, very bullish on the multifamily sector. And then the next question is, what's their strategy for controlling costs and reducing risks? Are they well capitalized? Is the strategy diversified? And then most importantly, because this is a government program, you want to make sure that your sponsors have the proper compliance and legal protocols in place so they don't step over the foul line and put the QOF status in jeopardy. So.
Yeah, that's great.
I think I want to just to piggyback on that last comment. I found it amazing, particularly early on. We spoke at a number of conferences. We've been on a number of panels. We're subject matter experts. I always found it a little disconcerting that there were sponsors that kind of came out of the middle of nowhere and say, boom, I'm in the Qualified Opportunity Zone Fund business, without really having a full appreciation that when you go down this road, we are wedded to these investors for the better part of it for over a decade. So as part of the sponsor due diligence, and I appreciate the comment, Eric, you've got to be comfortable that the sponsor is going to be around for 10 years and they can continue to service those clients. And to the point that you made, Eric, there's a lot of compliance protocol that has to be wrapped around fund management and how we report and when we report. This is an area that's come under a fair amount of scrutiny lately just because of some of the bad actors, I would say, are bad actors in the space. The good news, I think, ultimately is that the GAO, the General Accountability Office, did a study, and I think, and they released that study at the end of last year, and they were ultimately very favorably pleased with the amount of investment that was coming through the Qualified Opportunity Zone legislation, how those investments were really targeted to the betterment of their local communities. I mean, you think about us investing $2.2 billion in 20 different Qualified Opportunity Zone communities around the country, the incredible positive economic impact that has on the ground, both from a employment and labor perspective, but all of the collateral and ancillary services that go along with adding another 700 residents to a specific community has got a real multiplier effect in terms of the economic benefit to those communities. So I think that the legislation has largely been successful. I'm hopeful that there is a bill floating around. It won't have the strength to stand on its own, but it's a Qualified Opportunity Zone Extension Act, which was HR Bill 1 last year, that I'm hoping gets attached to some of the other tax policy and legislation that's going to be passed. Much like the Investment Opportunities Act was not a bill that was going to get passed on its own, but was, as I said, subsumed into the Tax Cut and Jobs Act. There's still a lot of bipartisan support on both ends of the aisle and both sides of the aisle with respect to this legislation, which is very positive. I can tell you in the last administration, last couple of administrations, we've become increasingly less bipartisan. So it's nice that you've got a program, a government-sponsored program here that still garners a lot of bipartisan support. So it's good to see.
Thanks, Kevin. No, that's very helpful. Before we get into Q&A, I just want to talk just very quickly about just the profiles we tend to see of our investors. Kevin talked about the sale of real estate. One of the things that's really powerful about the sale of real estate and thinking about it in the context of an opportunity zone fund investment versus a 1031 investment is the opportunity to separate basis from gains. So in an opportunity zone fund investment, you're investing a gain or part thereof, you get to take your basis back. So for investors that don't have an extraordinarily low basis, this is a compelling way to deal with some of the tax implications of selling that real estate asset. And it's also a way for you to take back the basis and build a diversified portfolio with it. The other thing that becomes interesting in that structure is when the real estate is owned by several partners, and those partners don't necessarily want their kids to have to be in business together down the road. So we tend to see, as opposed to the 1031 transaction in that case, an investment into an opportunity zone fund where the partnership or LLC that owned the real estate realizes the gain, distributes the proceeds to the individuals, and then the individuals invest in the opportunity zone fund. We see a fair amount of folks that are harvesting gains from growth portfolios, which is obviously part of the security sale component, but also the retirement planning component. Obviously, for retirement planning, you've got a lot of investors that you work with likely that are 4 or 5, 6 years away from retirement. So this is a way of getting both growth and income, and 4 to 5 years down the road, generating that income in a very tax efficient way. And then on the business planning, business sales side, obviously that investor has a gain, has to deal with that gain. This is a way of getting additional diversification with real estate exposure into that portfolio, but also for tax planning purposes, spreading out when they take those gains liabilities over time. So I want to jump to Q&A quickly. We have a question that came in. It says, given the favorable tax treatment of opportunity zone investments, what is the driver behind institutional investments in opportunity zones when many of them have favorable tax status? And I think that's just a misunderstanding. What we were articulating is that the ability for institutions to acquire multifamily and their desire to acquire more multifamily is part of what makes pricing so favorable in that market. And obviously, as an opportunity zone fund investor, and more importantly, as a multifamily developer, we're really focused on what that value is 4 to 5 years out when we look to recapitalize that asset and distribute money back, as well as what the value of the portfolio looks like after 10 years when we go to liquidate that portfolio. So to the extent that there is strong institutional interest in the asset class, that's very constructive to valuations. And so we want to be investing into a market where other people want to own those assets, because that is going to be good for values when we refinance the assets and then ultimately when we sell the assets. We don't see tax favorable investors making investments in opportunity zones because to the extent that you don't have a capital gain, you don't get the benefit of the tax legislation. Chris, did you see any other questions come in, or I think? Well, I
had one comment and then a question. It's great to hear that you feel the legislation has been successful. I'll tell you this: there's been a few articles out there, a few that were floating around amongst our board here, that it wasn't performing what the intention was. So if you guys can collect your data of how you're having positive impact and get that into the right hands, there could be a further paper of this program has been successful, and it may even be the catalyst that creates that extension that I think all of us would like to be able to see. So that's my comment. One of the questions is, let's take a step back to exit. You're looking at anytime you get something that's where there's an end date to an event that's occurring, you can actually have an occurrence of where you might have a lot of people trying to exit all at the same time. And it's been pretty prolific where there's not just you guys, but a number of different people creating funds for this exact purpose. What is your thoughts or your beliefs of, well, okay, we get 10 years out, and how many people are going to be looking to sell? How much money is going to be coming out of this? And people are going to be rebalancing per se. You might have some people that naturally, hey, I'm in a great real estate investment. Why would I want to sell? But there could be the other side as well, to where you're seeing maybe exodus is a strong word, but when we get to that end of that 10-year period, how are you guys thinking about that now, or is it not a concern to you?
Yeah, it's a great question, Chris. And I'll tell you, because having thought through this, there's a couple responses. One of the more interesting ones is once the designation was made in June of 2018, one of the questions that comes back is, hey, what happens with the 2020 census? And am I now going to lose the status of a qualified opportunity zone? And the answer to that is no. That's indelibly marked. So once those 6,700 designations were made, there's no change. Not only there's no change as a result of what happens from the 2020 census, but it's designated as a qualified opportunity zone all the way through the end of 2047. So theoretically, you could hold these assets through the end of 2047 and realize all of that appreciation tax-free in 2047. Now, that's not the way we underwrite it. So we underwrite it as basically a 10-year hold, so that we're ready to exit and push the exit button as soon as that 10-year period is up. But we've got latitude and flexibility if we need to extend it for another year or two to make sure we're hitting the right window. I will tell you two responses. One is, I'm not really worried about a flood of properties coming onto the market in 2032 or 2033, because as much as you've heard a lot about the size of the qualified opportunity zone fund market and the amount of development activity that's undergoing that could potentially exit in 10 years, it's still a very, very small percentage of the overall real estate capital markets. So I don't really believe it's going to move the needle appreciably. I worry more about what the environment's going to look like in 2032, the overall global real estate market, than I do whether or not there's going to be a supply glut. And that's why you want to build in a little flexibility to the end game and when you actually have to monetize, and give yourself some latitude and flexibility to push it out a year or two. I mean, if in 2032 we're experiencing what we experienced during the great financial crisis, that is not a good time to be transacting. You're going to want to sit on that portfolio, particularly if you've got a performing portfolio that's throwing off a nice tax efficient yield. That's much more of a concern than the supply glut. And you build in that flexibility so that you can be sure you exit at the appropriate time relative to what's going on in the overall market. And again, we're driven first as an investor and second as a sponsor. So we're patient, and we can exercise that discipline and patience to make sure that we're exiting at the right time.
That makes sense. Eric, we have a question that came in just as a function of our thoughts on interest rates, right? Obviously, likely in a rising rate environment, who knows, but likely in a rising rate environment, how much of a rise in rates is baked into sort of the way you model capital costs when you recapitalize the asset?
No, that's a good question. We build in a spread, and just to give you an example, that spread's typically 150 to 200 basis points over the interest rates at the time. So, for example, our construction loans are LIBOR-based loans. LIBOR's in the 10, 12 basis point range, and our spread with our lenders is called in the 250 basis point range. So the rate may be 2.6% at the time. In our underwriting, we're typically in the 4.5% to 5.5% range on our underwriting. In fact, we're seeing some great savings on our interest costs in both funds 1 and 2 because we have built in those spreads. And then we do the same thing on the permanent debt side as well.
So I think that was really the question is, obviously you have your cost of capital with your construction financing. What do you underwrite in terms of your perm debt?
Yeah, we're again in the 5 to 5.5% range. If you were going to get a Fannie or Freddie loan today, that would be in the low threes. So again, about a 200 to 250 basis point spread over today's rates.
Yeah, and the other thing is that it's dynamic, right? These are dynamic issues. So what I mean by that is, if we are at a period of time where we're going to see some protracted interest rate increases, that's generally occasioned by a strong underlying economy, right? To the extent that you got a strong underlying economy, you've got inflation baked in the economy, that increases your construction costs. Increasing construction costs drive real rental rate growth. So you may see increasing interest rates, but you also should be met at the other end with some real increases in rental income too. So that's going to add more value to the capital asset and allow you to affect the kind of refinancing you need to affect so that you could pass through debt finance distributions to the investors at the appropriate period.
Right, and given we're in such a low interest rate environment, it's just prudent to build in those kinds of spreads.
And Kevin, we had an interesting question that came in, really pertains to how we think about when we exit. If we have some investors that want to stay, some that want to go, is there an opportunity to recapitalize out those investors that want to leave and allow a mechanism for those investors who want to stay?
Yeah, so that gets back to the amount of time and effort we think about what that exit's going to look like. So one of the things that we would certainly entertain is we could convert, once the portfolio is stabilized, we could convert the limited partnership into a real estate investment trust. And then the individual investors could decide, as assuming that there's liquidity associated with the real estate investment trust vehicle, then the individual investors could decide for themselves when they wanted to sell their stock or their operating partnership unit in the real estate investment trust. I made the reference earlier to Avalon Bay as being one of the largest multifamily real estate investment trusts in the country. One of the options that we could pursue, and one of the reasons why you have an extra arrow in your quiver focusing on a single asset class, is certainly one of the discussions we'd want to have. And let's say we didn't convert to a REIT. Let's say we stayed as an operating as a limited partnership. We could do what's called a tax-deferred 721 exchange, swap our limited partnership units for operating partnership units in the umbrella REIT, and then distribute those operating partnership units to the investors and let them decide when they wanted to realize a liquidity event themselves and put it entirely in their hands. So, we think through those machinations. It's more complicated and there's more optionality than just getting 10 years out and saying, okay, let's sell the portfolio, let's sell a series of individual assets.
Kevin, in that structure, the taxable event to the investor would occur when they sell their operating partnership units of the REIT, correct? So they continue to grow tax-free?
That's correct.
Yeah, I mean, that's incredibly powerful.
Well, that would be my desire. It'd be my desire, not just for all the investors, but for us too, as an entity that's invested in the fund itself. And, I go 10 years down the road, 10 years from today, I mean, I'm already like gray and white. I can't imagine what I'm going to look like in 10 more years. And I'm not going to want to have my kids having to make decisions as it relates to whether or not they should be selling individual assets. But from an estate planning perspective, from a tax planning perspective, the ability to distribute limited partnership units or operating partnership units in a $40 billion publicly traded multifamily REIT is just much more elegant from an estate planning perspective.
Chris, anything else we should address?
Well, I don't see any other questions coming around, and I always like to have, for the people who are listening, a little bit of a tool to walk away from. It's not, if it's possible, and seeing as you guys are definitely experts in the space, you know a lot about your fund, but you probably know a lot about, everyone else who's participating in a broader base. For investors, which they come in lots of flavors and sizes, they may not be able to be the person where, my RIA doesn't have the ability to do alternatives or something of that nature. I don't have the ability to get access to your fund. What are some of the other resources or things that you could suggest to someone to do further education, further due diligence, to maybe find an investment opportunity in this space? that matches maybe their size or their particular needs if your fund doesn't. Maybe they're smaller, maybe they're, accredited, but, they can't write the certain ticket sizes. I mean, any thoughts or, ways for people to get access and start their process of educating themselves and finding other, viable funds if your fund's not a particular fit. I mean, a lot of times there's information sources. I will say that one of the things, there's lots of various research materials through Kaya, but they don't really have a program of like, well, who else is out there. It's not something that Kaya does, but I didn't know if you knew of anything that existed for people.
I would tell you that. So we have some really good educational materials on our website that you can, access directly by going to www.griffincapital.com and pull down some of that material. There's a lot of material, as you can appreciate on the internet. And Chris, I thought we covered this before we started this call. We're the only fund out there worth investing in. No, but in all seriousness, our funds generally have $150,000 minimum investment. Okay. We are a registered investment advisor, so the individual investors have to both be accredited and qualified clients, which is the $2.3 million person. But I would tell you, our fund auditor is a firm called Novogradac & Company, and they're headquartered in San Francisco. And just curiously, Michael Novogradac, who started that firm in 1986, was a business school classmate of mine at Berkeley way back in the day. And he has really built an incredible franchise from an accounting perspective, because their focus and niche really is on tax-driven legislation and how it impacts real estate, and that's the focus of their practice. They have regular qualified opportunity zone fund events. They just got a notice about whether or not we wanted to sponsor one of their spring events. So there's a couple of those. There's a couple of those firms, and Novogradac Company tracks, I think, 900 or 1,000 of these funds, and a lot of them are smaller. I mean, ours are we are probably the number, 2 or 3 capital raiser in the space, just given the size of our funds. There are a lot of fund sponsors out there that are doing this, one-off transactions, smaller deals, more local. And Novogradac & Company is a good source of information. It's right. Novogradac, Novogradac & Company.
Nice. Well, there you go, everybody.
And they have a great website. They have a great website full of information. So to the extent that ours doesn't provide you what you're looking for, I would visit Novogradac's website as well.
Yeah, I think it's, I'm pretty sure it's www.novo.com.
Perfect. There you go. You can go to Griffin's site, pull down a bunch of stuff. I know the CAI has some things, and now you have a third resource. So for those people who are on this call or watch it later, there's some good places to get started. Well, gentlemen, I don't see any other questions coming through. And if you don't have any other statements, I really appreciate the time. This is, like I said, super timely. I do get a lot of questions on these things. So I know I've actually already guided a few people your way for information. So thank you again.
Well, listen, we really appreciate the opportunity, and we're big supporters of your organization. So thank you very much.
Thank you. And thank you, everybody, for joining us.
This concludes our webcast. Thank you all for joining us, and we hope you'll connect with us again at our next Kaya event. Thanks, everyone.
All right, thank you.